It seems that way. The market is assuming that there will not be a trade war. I mean, if there is a trade war and it is anything on the scale of the tariffs that are being discussed right now, the impacts will be very substantial in the stock market. So I think the stock market is, Trump is kind of winning and everything's going to be okay in the end. I would say that's kind of what he's kind of winning the war of words. Chinese stock market's going down. Our stock market's hanging in there. Everything's going to be okay. Don't worry about it, at least for most of the month of August.
Does that feel right to you?
It doesn't, only because I think that it's more uncertainty than really we need right now, and it's dangerous. It's life and world events tend to be unpredictable. And so the idea that Trump's going to, quote unquote, get away with a last minute negotiation and the Chinese are going to somehow save face in the process just seems unlikely to me. But that's just my best guess. The stock market,
nobody knows.
The stock market thinks otherwise. Stock market also thinks that a flat bond yield curve is okay. And the stock market also thinks that budget deficits don't matter. So the stock market doesn't care about a bunch of things right now. I don't know whether or not it'll be right. We'll know come October is my guess.
Well, they seem to modestly care about the jobs report, Jim. I mean, it was a little below expectations, but big revisions in May and June. I think it was 224,000 now, the average. Pretty remarkable for 3 months in the latter half of an economic expansion, for sure. It doesn't seem to have changed the Fed narrative either. What's your thoughts?
Well, actually, I think it supports the Fed narrative. The jobs numbers was actually a little bit disappointing, even though the revisions were positive. And so I think we get slow and steady out of the Fed, and that actually is supportive of the market. I hate when we agree. I mean, agreeing is really boring, right? I mean, that makes for that's terrible. But
especially
I do think
with Evan Newman.
I don't want to agree with Evan. But especially, I think we're in a see no evil, hear no evil market. I mean, clearly this issue with trade in China could be catastrophic for U.S. industries. I mean, we look at U.S. exports. U.S. exports are primarily large-scale industrials that were exporting, Boeing, et cetera. You put 25% tariffs on those, it could shut those businesses down. It could just meaningfully disrupt the global supply chain. And so when I see volatility falling, when the rhetoric in Washington is rising, that makes me think there's a disconnect. When I see disconnects, that's when there's surprises. And when there's surprises, that's when you see big moves.
Don't you think, Bob, the whole thing was about the wage number, the fact that it was a modest 2.7% from last year and not something higher, and therefore the Fed doesn't need to be worried about inflation was the whole key?
If it would have been 0.4, it was 0.3. That was a tad on the hot side, but it would have been 0.4, 0.5. Oh, yeah, you could see the immediate response to the bond market. Yields actually, short term, they moved down.
Right.
So, yes, if it would have been higher there. But I do think that the economic growth continues here. That supports the economic growth, moderate inflation story that the Fed's been talking about. It was perfect for their playbook.
Speaking of lower yields, maybe one reason why consumer staples were the best performing S&P sector today, that was led by Kraft Heinz, the food company, finishing the session up sharply, having its best day since back in 2017 after reporting a beat on both the top and bottom line, announcing it expects profitability and sales to improve. Separately, Kraft is reportedly interested in buying Campbell's Soup. I cover these names, Evan. It's really hard to find growth. I mean, this is an 8.5% move off the back of negative sales growth.
I think, I don't know if P&G had any sales growth. Probably not.
They did a little.
A little bit. They basically came
1%
out. P&G came out and said, oh, we're going to raise prices on Pampers and a bunch of other things. It's going to be interesting to see. We'll only really know in 3 to 6 months whether they can get the price increases to stick. It's a story of, on the one hand, you have Amazon, which has basically been causing this giant deflationary trend in the economy. On the other hand, you have the consumer staple companies that need price increases. And it's a little unclear where it's going to shake out in the end.
But how do you get that? You not only can't have price, you have brand erosion now. So you've got commodities, you've got a brand erosion. It's just a plague for them at all. It's remarkable they've even been bouncing.
Right, but the stock market got that. I mean, all these stocks, Kraft Heinz is down 30% from its highs still, even after the recent bounce. P&G is down, 15, 20%. I mean, none of these stocks have been doing really well this year, and it's because the market's kind of been ahead of that. I think they see that.
Well, you also have the deal speculation. I mean, does that make them attractive?
You definitely have the deal speculation, but I think what's really happening with these stocks is they're basically low-growth stocks with high dividends. What's a low-growth company with a high dividend? It's really a bond. And so I think they've been trading largely with interest rates. So there's a whole segment of the market out there that's rotated from low-yield bonds into high-dividend-paying, low-volatility stocks, which is what consumer staples are. As bond yields rise, that money's moving back into bonds, which I think accounts for a lot of the loss in the sector sort of year to date. I think that once we get sort of to a certain level on fixed income, once we get to a certain level on yields, I think that rotation stops, and then the fundamentals for these companies.
What is that? We had 3% this week.
Yeah, I think it's probably 3.5%, and then the fundamentals will start to matter even more. But if you look at the correlation between yields and these sort of low volatility, high yield names, it's actually been quite strong over the last 24 months.